very respected Yagnesh Desai from Mumbai, Secretary of ICCI Panaraj, participants of this evening, very good evening to all of you. Accounting is the heart of every economy, which makes sure the money flow is regulated and enabling the administrators to ensure right distribution of funds and related management. Indian economy being the fastest growing economy with a high demographic dividend, it is important that accounting is standardized. We are in the scenario where we have to encourage entrepreneurship, employment opportunities for the economy to grow, rather for us to survive. And a true and fair accounting is a vital element for the big vision of our national growth. While we have to accept and acknowledge that bringing in accounting standards in all levels of enterprise will have its own initial challenges. However, this is a generation of changes, and as we adapted other changes in law and taxation. We will have to bring this standardization to ensure the nation's growth and the economy is driven in the right direction. After all, it is these numbers which are going to be the basics of all decisions. Today we have with us CA Yagnesh Desai to discuss about accounting standards for non-corporate entity, and I am sure he will give great inputs to the professionals for this great subject. On behalf of members of this region, I welcome him for this wonderful program and thank him for accepting our invitation to address us.
Namaskar ji, namaskar.
With this, I also welcome each one of the participants for this evening program. Now I request CA Panaraj sir to introduce the speaker of this evening. Sir, please unmute, sir. Panaraj sir, please unmute.
Thank you very much, Chairman. This is a historic event for the SIRC because for the first time we are conducting a program on applicability of accounting standards for non-corporate entities. Because 90% of the total practicing chartered accountants that are enrolled in the institute are SMPs, small and medium practitioners, whose main area of practice is non-corporate entities. So in this direction, no thought was given earlier. So I thank the chairman for choosing this topic, and which is very, very relevant for the day and for the current scenario. Because today I was attending a committee meeting on insurance and bankruptcy code and valuation. There, our Central Council member, Mr. MP Vijay Kumar, was emphasizing on the errors that are traced during the FRRB evaluations. So we have to be very cautious now because most of the things have become faceless. So this has become very, very important topic for all of us. And with us today, we are blessed with the presence of a senior chartered accountant and a certified public accountant of USA, Sri Yagnesh Desai sir. Once again, I welcome you and I take the pleasure of introducing you, sir. He is a member of the Institute of Chartered Accountants of India and also the American Institute of Certified Public Accountants. He has been in practice since 1983 August. 1983 August, I repeat. So the wide knowledge of audit of corporate and taxation matters actively associated with the activities of the Institute of Chartered Accountants also. IFRS trainer for certification course of INDIAS conducted by ICAI, and a trainer for diploma in IFRS examinations conducted by ICCI of UK. Composed and delivered e-lectures for accounting standards for the Institute of Chartered Accountants of India, and he has been a speaker on accounting and auditing standards at various seminars of the ICAI, and also delivered motivational speeches at various national conventions and students' conferences. Between 2009 April till date, they have delivered 1,006 sessions and seminars in about 40 cities in India and abroad. This is the 1007th session for us. Recently is awarded with Icon 2021 of Mumbai City by Times Group. uh, hobby of comparing music shows, taken part in half marathons, co-opted member of the Accounting Standards Board of ICAI. This is the brief profile of this very prolific personality and great personality. He has been into so many other activities also. We should be, you are definitely worth taking, worth following example for all of us, sir. Thank you very much, and over to you, sir. Very proud to have you on.
Namaskar, Vanakkam, and good evening to everybody, sir. Good evening to everybody.
Vanakkam.
Chairman, sir, Mr. Jalapati, and Mr. Pandaraj, the Secretary of SIRC, I thank you very much for giving me a pleasure to share the whatever I learned about accounting standards with all my professional brothers. And good evening to all participants. I believe I was told that there are more than 500 participants, so I salute all of them, and good evening to everybody. Okay, Ippadi Sukam, all of you, Ippadi Sukam. Okay, and before I start, I always acknowledge, and just now Mr. Pandaraj mentioned about MP Vijay Kumarji. MP Vijay Kumarji, I herald him and respect and hold him as the father of accounting standard, Bhishma Pita of accounting standard. He is an authority on accounting standards, and besides that, he's a very humble gentleman. So even at this stage, and in the 39 years of my practice, whenever I face any problem or if I have any clarification or concern, any clarification I need from him, he is always ready to help us. So I'm grateful to Mr. your own MP Vijay Kumar sir, and that's a great personality. I mean, besides, and he's also a towering personality in terms of the physics also, right? And same is in his career. And I must also compliment and congratulate the present and the past president of ICAI, as well as the chairman and vice chairman of Accounting Standard Board for making this possible, this kind of webinar. Now, imagine I'm sitting in Mumbai and many participants are sitting in their own home, and we are still connected. It's like the world is in your fits, correct, sir? And we are on the same platform. Thank you very much, sir, once again. And as your chairman, sir, Jalapati Sahab here, this is the generation of change. Very well said, sir. Very well said. We are facing changes on all fronts, whether it is a GST, whether it is the income tax, whether it is the Companies Act, and not to leave aside accounting standards, right, sir? So very good topic selected by you, and very contemporary topics, sir, also. Now, with your permission, I am now sharing the screen. I'm sharing the screen. So, can you see the screen, sir? Can you see the screen?
Yes, sir. Yes,
Okay.
sir.
Thank you, sir. So now I'll start my deliberation, sir. So the
Yes,
first place, yeah. Okay. In the first place, these are not new accounting standards. The accounting standards was already there. These accounting standards were already there. They are not new standard. What has changed is the criteria for selection of criteria for the applicability of certain standards. Now, this is very important. Again, to repeat, these standards were already there. But as our Secretary Saab has said, so whenever we think of the accounting standard, we always think of the corporate bodies like private or public limited companies, and we always tend to think that as if these standards are not applicable to partnership firms, association of individuals, or body of individuals, or the HUFs or the individuals. So partner standards were considered as if they are meant only for the corporate bodies only. But now this has made it very clear that they were applicable even to the non-corporate entities. Now, dear friend, there is one change in this. I would like to say that one second. The title for your program is a non-corporate entities, sir, but I like, and that's why I have used the same title here. But sir, I like to tell you one thing: the word non-corporates was used earlier, but now it is a non-company entities. Now the new phrase is non-company entities. So we'll see all this, sir. And I must also acknowledge and thankful for this publications to ICAI, and that is the first being the primary being the announcement criteria for classification of non-company entities for the applicability of accounting standards. My dear friends, you can see the word, there's a change in the physiology from non-corporate to non-company entities. Now I'll explain you the reason and the rationale for that. Second is the Compendium of Accounting Standards, July 2019, and the third is the guidance note for the tax audit. Now you may be wondering why YMD Rakesh Roshan has considered or is referring to the guidance note on the tax audit. The reason being, tax audit is considered to be one of the assurance engagement. It's one of the assurance engagement, and we as a chartered accountant, we as a member of the ICI have to apply the accounting standards wherever there is the assurance or the attestation engagement, and tax audit is one of the attestation engagement, and that's the reason I have mentioned the tax audit guidance note here. Now let us remember one thing before we start into this. Discussions in this presentation is concerning the exemptions applicable only to level 3, 2, 3 and 4 and non-corporate, non-company entities. Now level 2, level 3 and level 4, they are collectively referred as micro, small and medium enterprises, MSME. And now that means this discussion is not applicable to entities other than the NCE, that means the non-company entities, or the MSME. So mind you well, friend, this criteria, this classification is only for the non-company entities. What does mean? What does it also mean? That for the corporate entities like private limited company or public limited company, the criteria will continue to there are 2 levels as of now. As of now, there were 2 levels: level 1, level 2 and level 3. Level 4 has been added by virtue of this this clarification, which is issued in March 2021, and this criteria is applicable for financial statements ending on 31st March 2021. This clarification is applicable, this classification is applicable to financial statements prepared for the financial year 2021. That means the one which is just concluded, it is applicable to them. What do you mean by it? The new classification. Earlier, there were 3 classifications: level 1, level 2, level 3. Now there are 4 classifications: level 1, 2, 3, 4. Now what has changed to for these levels, for these classifications? The threshold limits applicable, which is based on the turnover, A, and second on the bank borrowings, on the borrowings. So these 2 limits have been changed. But the best part is there, sir, in both the cases, in level 2, 3 and 4, there is a relaxation from the applicability of the accounting standards, and we will see that what kind of relaxations have been given to the non-company entities, which also sometimes people say they are the non-regulated entities. Many people sometimes say they are the non-regulated entities. Okay. Now this circular has not been made. Now this circular has not made any changes in the existing standards. Sir and friends, my dear participants, chartered accountants, fellow members, please remember, no change in the standards. Absolutely not an iota of changes in any of the standards. Only thing is that there is a change in the applicability of the accounting standards to non-company entities. Mind you well, I have changed my phrase from non-corporate to non-company. Reason I'll explain you, but after some slides, not now. You need to wait for some time. Now, the only criteria for the non-company entities have been changed. So in other words, the criteria for the companies have not been changed. Existing classification, which is based on level 1, level 2 and level 3, which is applicable to the companies, have not been changed. So concurrently, there will be 2 classifications: concurrently, simultaneously, at the same time. The applicability criteria will be there will be two sets of applicability criteria. One which is applicable to non-company entities, which is already there, level 1, 2 and 3. This will remain intact. In other words, the new classification criteria for level 2, 3 and 4, known as the MSME, is not going to make the existing level 1, 2, 3 as invalid, but they will still going to continue to apply to the to the company entities. So please remember, the change in the criteria for level 2, 3 and 4 is only and only for non-company entities. Friends, it may tantamount to jumping the guns. But allow me a minute, and I'm going to freeze my screen for a minute. I'm going to change to one particular Excel sheet, and this sheet is here. Okay. Friends, can you see the Excel sheet on your screen, sir? Can anyone tell me, please? Hello? Can you see the Excel sheet on your screen, sir? Hello?
Yes, sir, we can see that.
You can see now. Just give me humming sound and say yes or no, because that's where I understand that you are watching the correct slide or the correct material is there on the screen. Now, sir, I have done something here. This were the criteria. This was level 1, 2 and 3. As you can see, level 4 was not in existence. Okay, and even it is not existent even today also for the non-company entities. For corporate, that means the private limited companies and public limited companies and even LLPs, the criteria for applicability of standard for the level 1 was more than 50 crores. So if a company which had a turnover of 51 crore, it was covered in level 1. And it is covered in level 1 even today also. Why am I saying was? Because this is applicable to the company. So company, if it is a private limited company and it has a turnover of 51 crore, even today also, even after 31st March 21, after the publication of this clarification by ICAI Accounting Standard Board, even today, if it is a private limited company and if it is a turnover is 51 crore rupees, it is considered to be part of level 1 category. Now you may ask me a question, sir. You're harping on us since beginning, level 1, level 2, level 3, level 4. But what is significance of level 1, level 2 and level 4? The significance of level 1 is all accounting standards are applicable to level 1 entity. All 27 standards are applicable to level 1 entity. All right. Now, what is change? What is change for the non-company entities? My dear friends, I am changing the phrase from a corporate to company. Okay, so non-company entities, now the turnover has been raised from 50 crores to 5 times to 250 crore rupees. Now let us take the comparison. Computer G, Mr. Computer, let us see. So if it is a private limited company, and second is a partnership firm. All right, now the turnover of private limited company is 51 crore and turnover of the partnership firm is again say 51 crore rupees. So private limited company will be classified even today as level 1 entity. Why? Because the level criteria, the criteria of level 1, 2 and 3, which is applicable to the corporate entities, have not remained changed. They have remained unchanged. Sir, am I audible properly, sir? Hello?
Yes,
Hello?
sir.
Am I audible,
Yes, sir.
sir?
Yeah,
Okay.
audible.
Thank you. I need your endorsement, sir. I
Okay,
did.
no problem.
And how do you find the going, sir? It is okay? Is okay the
Sir?
speed, the
Yes, sir, yes, sir. Fine, sir.
the
Fine, sir. Fine.
diction, the pronunciation is okay? It is not like
Yes,
Guju
sir.
one,
Okay,
no?
sir. Okay.
It is
Okay,
not
sir,
like
very
the
much.
good pronunciation. Okay, sir. So now let's say a private limited company has a turnover of 51 crore rupees. It will continue to be considered as a level 1 entity. Why? Because it is a corporate entity. Now see, the same year a firm has a turnover of 51 crore rupees. Now, if it is a turnover of 51 crore rupees, then it will fall into which category, sir? It will fall into this category. It is more than less than 51 crore rupees. So it will again fall into the this category, sir. It will fall into the residual category, sir. So now the criteria is changed altogether. See the relaxations which was given to the earlier private limited, to the new non-company entities. So why was this need? Why was this need to give this kind of a relaxations to the non-company entities? Because the ICI has thought and has considered that look, compliance of the accounting standard for the non-company entities may be a bit cumbersome, may be difficult to comply, and that's why that's why the accounting standard board has changed has given the relaxation of the applicability of the accounting standards. And you can see now that that company the turnover criteria is more than 10 crores but less than 50 crores. It does not fit even level 3 also. That means it will be in category 3 of 3. Now if you see, this is the table which gives you that applicability of the standards, correct? Now if you go to see level 1 entities, all standards are applicable, all standards, and so all 27 standards are applicable to level 1 entity. Now what is a level 1 entity? Again, don't make mistake of applying this criteria of turnover and borrowings to a private limited or a public limited company. These are meant only for the non-company entity. I repeat, sir, I am non-company entity and not non-corporate, because even LLPs are considered to be a corporate entity. So the existing criteria are this. Just a minute, sir. Mr. Computer, please. Okay. So the existing criteria of 50 crore rupees or more for the level 1, and 40 lakhs but less than 50 crore rupees and less than 40 lakhs rupees is in 3 category number 3. This is the residual category. The entity which is not covered in level 1 and level 2 are not considered to be the level 3. Again, this is only for private and public limited company. For NCE, for which you have all gathered today, the new criteria will be applicable for accounting period beginning from 2021. So the financial statements of the year 2020 and 21 will be covered in the new criteria which is given here. These are the new criteria for the non-corporate entities. So I will say this will cover a private limited company, a public limited company, and even the LLPs, where this will be covering other than above, which will be other than above. Sir, no new standards have been announced. The same standards are going to be applicable to this to those non-company entities also. No change in the standards, only the applicability criteria has been changed. All right. And same is the case here about the borrowing, right, sir? Fine. So we'll see later on that what kind of relaxations have been given to the level 4 entities. So let us see a level 4 entity is the one in which the turnover is less than 10 crore rupees. If the turnover is less than 10 crore rupees, then it is considered as a level 4 entity, a non-company entity. And let us see, we're going to discuss in great detail also, but I want to set up the tone here, and this is here. If you go to see level 4 entity have been given relaxation into how many standards? Let us see the summary. the fully applicable standards are only 8. I will use the word fully applicable. There are only 8 standards which are fully applicable to level 4 entities, or sorry, level 4 non-company entities. And it has been given relaxation from the not applicability by 11 for 11 standards. Imagine out of 27, 11 standards are not applicable at all. And applicable for the disclosure, and certain standards are applicable, but they have been given relaxation on the disclosure. And applicable with exemption only one standard, and applicability of the applicable partially. Yeah, there is one standard which is partially applicable to level 4 entity, and that is an exceptional standard called AS22, in which an entity, if it is a level 4 non-company entity, it is not required to recognize and measure deferred tax, either liability or asset. So these are the benefits of the relaxations given in the new declaration. Okay, so fine. So I wanted to make these things clear, that the existing criteria level 1, 2, 3 for the corporate entities remain intact, unchanged, not changed. They have created the new criteria by adding one more level, and that's level 4 for the, and these are for the non-company entities. Level 2, level 3 and level 4 are known as the non-company entities, collectively MSME. Now they were classified like this, sir. If you go to see, the classification criteria is like this, sir. The scheme with effect from April 20, that means applicable for the financial year ending 2021. Large size entities more than 250 crore. Again, there's a borrowing also. Level 2 entities are medium size, level 3 are small size, and level 4 are micro. 2, 3 and 4 are referred to collectively as MSME. Sir, what is the criteria of why they've changed this? Because this they've changed in line with the threshold limits, or the change in the threshold limit for the micro and small and medium enterprises as per the Ministry of Corporate Affairs. Now, though they have mentioned these, that level 1, level 2, level 3, level 4 for the non-company entities are going to be effective from April 20. That means for financial year 2021. They made it very clear that if by any chance an entity is covered by Ind AS, you may wonder, sir, how a non-company entity is covered by Ind AS. Yes, there are chances. If a partnership firm is considered to be a joint venture of a public limited company, or a company which is required to follow the Ind AS, then the partnership firm is also it also has to apply the Ind AS, even if the criteria of other applicability of Ind AS is not applicable to it. Because we know it very well that as far as Ind AS is concerned, if an entity is covered by Ind AS, its holding, its subsidiary, its associates, and its JVs, all of them have to follow the Ind AS, even if this criteria of applicability of Ind AS is not applicable otherwise to the entity as such. So this is one exception you have to keep in mind. And now we will see what are the differences between the level 1, which was meant for the private limited company, and why I would say it is meant for the private limited company even today also. So I would say, Mr. Computer, I need the pointer. So I'm looking for the pointer. Mr. Computer, it is here. All right. So I would put it like this. Level 1 still remains same for corporate entities like private, public limited, private and public limited, and also the LLPs. So non-corporate entities now, earlier non-corporate entity, the word they used for the non-corporate entities now is a non-company entities. because they didn't want LLP to be considered as a non-company entity. Entities whose debts and securities are listed or in process of listing on the stock exchange, whether in India or outside. Entities whose securities are listed or in process of listing on any stock exchange, whether in India or outside India. SME now, as social stock exchange is a new concept which may come in India in a couple of years. It's not there now. Sir, I got this question because this is my fifth or sixth deliberation on the non-company entities. So I got a question from many forums. So tell me one thing, how a non-company entity can get listed on the stock exchange? Mr. Jalapati, yes, sir. Yeah, anyone may ask this question. Yes or no, Mr. Jalapati? Chairman, sir?
Sir?
Chairman, sir, are you there?
Yes.
Are you there, sir? Yeah, I like
Yes,
to
sir.
see
Yes,
your
sir.
face. Yeah,
Yes,
I
sir.
like to see your face because I want to feel that
Okay,
I am.
okay, sir. No problem, sir. No problem.
So at least when I ask the question, I like to see your charming face, sir. So, sir, anyone may ask you a question that how come, how a non-company entity is likely to be listed? Yes, there are entities. Say, for example, LIC of India is not a company under the Companies Act. It is not a corporate body, but it is a non-company entity. So LIC is one example. Then there is one. The government of India's securities are listed. So government of India is a listed entity. And then there are Amul India Limited. Again, this is also a non-company entity. So there are entities which are not limited company, not a private limited company, but they still their shares have been listed on the thing. Now there you can find some change here that equity or debt securities. Whereas here under the new criteria, they use the word securities only. So when we saw it first, we thought that okay, there may be some change in that, but later on we realized that the word security is under the SECRA is what covers the equity in debt. So if you look at the definition under subclause H of section 2, it says that securities include shares, scrip stocks, bonds, debentures, and debenture stocks. So there is no point. It doesn't make any difference anyway whether the word equity or debt has been replaced by the word securities. Fine. Banks, of course, they are also included. All commercial, industrial, and entities whose turnover was 50 crores earlier, it has now been reduced. It's now been increased by a whopping margin of 5 times, 250 crores. That means, but see the funniest part. If it is a private limited company and its turnover is 51 crore rupees, it has to comply with all the standards. As against that, there is a partnership firm, there is an association of persons or BO body of individuals whose turnover is 52 crore rupees, then it will not be covered in level 1 enterprises. So for that, the huge limit of 250 crore rupees has been applicable. That means many entities, many non-company entities will get out of the level 1 category. A big welcome change from the perspective of the applicability to the accounting standard. So when it comes to the turnover, you to excuse me because I had a very bad cough and cold, and in the afternoon I was sneezing. Then I took the steam and controlled my sneezing, but still I'm sorry about that, sir. Okay, so the turnover, the borrowing criteria was 10 crores, in excess of 10 crores, which has now been increased to 50 crore rupees. So you can see the number of changes, the amount of relaxation given in the level 1 entity applicability. So that means if an entity has a borrowing of 49 crore rupees, it will not be considered as a this. Now these conditions are or, not and not and. They are or, any one of them is applicable, that is applicable to, they will be covered by this level 1. So if the turnover is more than 250 crore rupees, but the borrowings are 40 crore rupees, it will still be covered because the limit, these are or, not and. This turnover and the borrowings are either of them, not both of them. And naturally, the holding subsidiary of them are not covered. So this is about the level 1. And let us now to the level 2 entities. Level 2 entities, the threshold limit was 40 lakhs and not in excess of 20, but not in excess of 50 crore rupees. Now this has been changed to 50 crore rupees, but not exceeding 250 crore rupees. So if it is less than 250 crore rupees, but even more than 50 crore, less than 250 crore rupees, but more than 50 crore rupees, it will be considered as level 2. Let with the private limited company, we'll look at the NC with an NV. Okay, look, your turnover is 100 crore rupees and you are considered to be the level 2 entities, whereas my turnover is 100 crore rupees and I am considered by way of this criteria as level 1 entity. Correct, sir? This I'm talking about the corporate entities. Sir, yesterday there was a session on the topic that common errors in the accounting standards applicability. And then in that forum, they've invited the ex-president, Mr. Amarjit Chopra. And Amarjit Chopra sir was also discussing about the level 1 and level 2 criteria, and which is recasted criteria for the non-company entities. So at that point of time, he explained, look here, the turnover criteria was 50 crore rupees, and then suddenly the second stage was 40 lakhs to 50 crores. Can you see the difference? Can you see the gap? That is 40 lakhs and 50 crore rupees. Not even 10 crores to 50 crore rupees, not even 5 crores to 50 crore rupees, or not even 1 crore to 50 crore rupees. Then he explained the reason for that. The reason was that he said when these levels were classified, the limit of the tax audit was 40 lakhs rupees. The limit applicable for the tax audit was 40 lakhs rupees. So they said that had we raised this 40 lakhs rupees limit then and made it 1 crore to 50 crore rupees, or even 5 crore to 50 crore rupees, the income tax department would have said, look, the ICAI is not applying certain standards to an entity which has a turnover of less than 10 crores or 5 crores or 1 crores. So why do we apply the tax audit to them? And that would have prompted the government, I'm so sorry, sir, prompted the government to increase the tax audit limit. Are you getting my point? So that was the rationale. He explained very nicely that once we have the 50 crore limit here, and suddenly the next level, immediate next level is talking about not exceeding, means less than 20 crore rupees, but not more than 40 lakhs. So that was the criteria. But now you see the relaxation there, exceeding 50 crore rupees, but not exceeding 250 crore rupees. So many companies will get weeded out from the applicability criteria. And when it comes to the turnover and borrowings, it was not in excess for 10 crore rupees, but now in excess of 10 crore rupees, but not in excess of 50 crores. So anything from 10 crore to 50 crore borrowings entity will be classified as the level 2. As you can see, non-company, non-corporate are not level 1 entities, but fall in any one or more. So these are not mutually exclusive, these are not cumulative, but they are or. Fine. Now level 3 was the residual category of SME earlier, and even it is a residual category even today for the corporate entities. It is today also the residual category for the private public limited company and even the LLPs. But again, the corporate entities will look at the NCE, non-company entities with an NV, and say that, look, your turnover is more than 10 crores, but less than 50 crore rupees, and you are given the status of level 3 categories. Now, level 3 categories one has to be very happy about, because it reduces the compliances of the accounting standards. It reduces the onus of applicability of the accounting standards. So there is something to be very happy about it. Okay, fine. And when it comes to the borrowings, they say in excess of 2 crore rupees, but not in excess of 10 crore rupees. Now, this leaves the only one category, and that's the category 4. Exceeds 10 crores, but not exceeds 50 crores. So if the turnover is less than 10 crores, if the turnover is less than 10 crores, then it will be considered as a level 4 entity. Or if the borrowings are less than 2 crore rupees, it will be considered as a small, and it will be considered as a level 4 entity. That's going to be the residual entity. So anything below 10 crores of the turnover or borrowings less than 2 crore rupees will be considered as the residual category, level 4 categories. Now let me see, Mr. Computer, whether this is taking that to the, okay. So we will take that. Okay, now let's, sir, can you see the Excel file on your screen, sir? Chairman, sir?
Yes, sir. Able to see,
Can
sir.
you see? Okay,
Yes,
okay,
sir.
it's visible. Huh? Okay, okay. Okay,
Able
okay,
to see.
yes, Mr. Pandaraj. Namaskar.
Yes, sir. Able to
Okay,
see.
you can see. Okay, thank you, Ji. Thank you.
Font size
Sir,
is a bit.
Sorry,
Font
sir?
size is small, sir. Font size.
Okay,
You can
okay.
help it seems, sir. Can it be enlarged, sir? Ah, fine. Now it is okay, sir.
Okay, sir?
Fine, sir.
Thank
Fine. Sir.
Sir, I must tell you, I miss the days of the physical meetings, in persona meetings.
Yeah,
Sir,
yeah.
this has become very dry. Now I have to act like a radio jockey, or even the TV narrator. You know, I have to
Yes.
just pretend that as if someone is sitting before me, and I say, "Hello, how are you?" This is like this,
Yes, yes.
but it becomes very dry. So that's why in all these dryness, when I see someone before me, and that too very smiling and charming like you and your chairman, it really helps me to make
Yeah.
it makes things very lively, sir.
Very much, yes, sir. We cut off our video only to see that the bandwidth is good for viewers.
No, I understand, and that's why I don't expect that you should be always there. But sometimes, if you're there, I feel very happy about it, sir.
All the
Then
time I'm here. Till the end I'm
then
here.
I say that Mogambo Khushua.
Yeah.
Mogambo is happy.
You are perfectly like a person.
Yes. So thank you, sir. So now, okay, now let me put off this ribbon, sir, and we'll see, sir, that what are the applicability. Now, as I told you, level 1 entity, all standards are applicable, and whereas these standards are not applicable at all to level 2, level 3, and level 4. So cash flow statement need not be prepared for this thing. So at this point of time, sir, let me remind that since this is a non-company entity, there is no question of the applicability of this subsection 40 of section 2 of the Companies Act, because if there are the companies, then as per the Companies Act, unless the company is a small company or a dormant company or a one-person company, cash flow statement is required to be prepared. So don't apply, please. Again, sir, a very humble request to all my fellow chartered accountants, that this limit, this criteria, this classification of level 1, 2, 3, and 4 is applicable only to non-company entities. So if you are doing the audit of a private limited company, and if that company's turnover is about 100 crore rupees, you have to prepare the cash flow statement, right, sir? So please don't make this mistake of applicability of this criteria to the corporate entities. So when you learn this, when you do the audit of the private or public limited or the LLPs, please close this window of NCE. Close this window. Forget all these 4 criteria. Okay. And when you do the audit of the non-company entities, like a partnership firm, association of person, or body of individuals, then you close the windows and forget this level 1, 2, 3, and 4. So you can see the one which is marked like this in full yellow are not applicable at all to the level 2 and level 3 and level 4 entities. We'll go down. Certain standards are applicable to level 2, level 3 and 4 entities, but they are applicable with exemptions. But friends, these exemptions are by and large, are related to the disclosure requirement. When you see applicable with exemptions, these exemptions are related to the disclosure requirement. My dear friends, any standard has got 4 cardinal principles: A, recognition; B, measurement; C, presentation; and D, disclosure. Recognition means whether to get it into the books of accounts or not. When a transaction or an event, when it meets the definition of the elements of financial statements as laid down in the framework for the preparation and presentation of the financial statement, they are recognized, they are booked, they are taken into consideration for preparing the balance sheet. Now, what are the elements of financial statements? Assets, liability, and equity. They are the elements of balance sheet. Income and expenses are the elements of the income statement. So you recognize them. Now, example, I buy something. It meets the definition of an asset, so I recognize asset. If it meets the definition of an expense, then I recognize expense. So this is the recognition part. Now, what is the measurement part? How much monetary value to assign to it? If I bought an equipment and I incurred some cost, so the cost is monetized and it is known as the measurement. And then we'll see the measurement at cost or fair value, blah, blah, blah. Now comes the presentation. Presentation is what you reflect, or to put in a very blunt and not very too sophisticated or the proper wording. When we show something in the balance sheet, profit and loss account, income statement, or the cash flow statement, we call it presentation. Okay, and what is not shown in these primary financial statements is known as a disclosure. So some exemption is given by the entity, by the standards for the non-company entities, for the exemption from the applicable from the exemption for the disclosure. Not applicable. Now, when I say yellow mark, they are not applicable at all. So segment entities, segment reporting is not applicable to level 2, level 3, level 4. Sir, sometimes I feel that all said and done, the standards were applicable to the non-company entities even before also. But tell me honestly, how many of us are following these standards while preparing the financial statements of the non-company entities? I don't want answer. I don't want answer from you, but you just answer this question to yourself. But for that, the awareness is also not there. I mean, not also awareness is not there on the part of the clients, for our parties, for our because if you tell them the stories of all this, they'll say, oh, I mean, we are not concerned about all this accounting standard because there is no regulatory body for us to to us. No, there's no regulatory body for us to compel us for this compliance. There is Indian Partnership Act 1932 does not say that you have to follow the accounting standards. HU of Hindu Succession Act or nobody says about the following the accounting standard. They say there's no compulsion by any regulatory authorities. So why do you ask us to do so? And so even if the chartered accountant in all dexterity and the compliance with the ICAI regulations and all this, they apply this. I don't think the client is going to pay you an extra penny for all your efforts. But sir, we being the member of the ICAI, we have to be abide by the ICAI directions. And the directions is that whenever you do the attestation function, you have to follow the accounting standard. Now you'll ask me a question, sir, where it is written? It is written the preface to the accounting standard, and it is also written in the one of the examples of the attest one of the living example of the attest standard. or the attest engagement is the tax audit under the Companies Act and under the Income Tax Act, TAR, tax audit report, more formally known as the TAR. So it is written there, and I'll show you. I have taken the excerpts from these two publications. One is the accounting standard. There is a preface, and second is the tax guidance note on the tax audit report. Now, applicable with the disclosure, there is now one exemption. This exemption is about the employee benefits. It was there earlier also. The same exemption is being repeated. There is one standard. There is one standard which is not applicable to the level 4, and that is concerning the that is AS22. AS22, there's a different color, applicable only for the current tax. AS22 dealing with the current tax and the deferred tax. As far as level 4 entity is concerned, it is not applicable for the deferred tax. And as far as impairment is concerned, again, it is not applicable to the level 4. There is no question. And there is one thing which is very interesting about the joint venture. Now here, I like to draw your attention that as far as level 2, level 3 and level 4 entities are concerned, level 2, level 3 and level 4 non-company entities are concerned, this standard of interest in joint venture is not applicable. But excuse me, very bad cough. But if an entity is entered into the joint venture, if an entity is entered into the joint venture, suppose if a partnership firm is entered into a joint venture, then it has to apply this standard 27. Otherwise, it is not applicable. Because you see that mostly whenever the joint venture agreements are entered into, they are in the form of the partnership firm also. So if a partnership firm is considered to be a joint venture of another partnership firm, then it has to apply the AS27. All right, now let's Mr. Computer, let's go to this. So this we have considered about the applicability of the level 1, level 2, level 3 comparisons. Now let us see this. Here I have made some small chart, and this chart is concerning the applicability of level 2 standards to level 2, level 3 and level 4. You may ask me question, sir, have you forgotten level 1? I have not forgotten level 1. The reason being, all standards are applicable to level 1 entity. I'll repeat, all standards are applicable to non-company level 1 non-company entities, and hence there is no level 1 here. Now fully applicable standards. Now these standards are applicable fully to this standard, like 16 standards are applicable to level 2 entities and 12 to level 3, and only 8 standards are applicable to level 4 entities. See the incidentally, what is the sequence? 12 minus 4 minus 4. Wow, 12 minus 4, 12, 16 minus 4, 12, and 12 minus 4 are 8. Certain standards are not applicable to level 2, level 3 and level 4 non-company entities. So these are decreasing and these are increasing. So applicability standards are decreasing and non-applicability standards are increasing. So there are 11 standards which are not applicable to level 4 entities, and we know the level 4 entities are the one which is having a turnover less than 10 crores and the borrowings less than 2 crore rupees. Now applicable with the disclosure exemption. Applicable with exemptions is 15, which was there earlier. They have continued same exemption even today, even now for the non-company entities. And applicable partially, AS22 income taxes is applicable partially to level 4 entity in terms of the fact that they don't have to recognize the defer tax assets, maybe asset or a liability. Except 22 only for level 4 entity, and AS28 mainly exemptions are related to the disclosure. Now we have seen all these exemptions. is, and mainly we'll see they are concerning the disclosure requirement. That means they have to still comply with 3 elements. What are the 3 elements? Recognition, measurement, and presentation. All right. Now you'll see that there are certain standards which are applicable to all 4 categories. These are applicable to all 4 categories, which is disclosure of accounting policy. Now here I'd like to draw your attention, friends, that even if your client does not agree, because when you do the tax audit, you have to comply with the accounting standards. Now, how many of us have not applied till now? Let us not discuss about that. Now, it's not that it is not applicable for this. It is applicable for the CAs in Chennai, or the level 1, level 2, level 4 city in take any part of the India, whether it's Bombay, Delhi, Calcutta, or anything, or any the level 2, tier 2, tier 3 cities. The compliance of the accounting standard for the tax audit report was not up to the mark. Let's not go into the fault that this CA is not good or the client is not good. Forget whatever has happened. But now onwards, you please start applying the accounting standards. Now, AS1 is of a prime importance, because if you comply with the disclosure of accounting policy standard AS1, it gives the message to the reader that look, this entity is applying the other accounting standards also. And not just for pretending, you must apply these standards. And I must say one thing, that there is one more reason for you to be all the more vigilant, because we were under the impression that who is observing it. Now you are going to be under the surveillance. What surveillance? We know that for the listed and the private companies, there is something called Financial Reporting and Review Board. This board used to examine and see the accounting, the financial statements, and see whether they have enough compliances or not. Compliances for the listed company in terms of the SEBI, and others for the non-listed entities, the other accounting standards. And the tax audit reports, or the private or the partnership firm, or the EOP or the BOI, no one was bothered about the application of this, because there were no regulatory bodies. But now Institute has set up something called a Tax Accounting Standard Board, TARB, and ICAI will now be selecting certain tax audit report, and they will be scrutinizing this report and see whether the accounting standard have been complied with or not. If I'm not mistaken, on 25th of May, there is one seminar or the one webinar which is about the common errors in the tax audit report. Chairman sir and even the secretary sir, please draw the attention of the members to this webinar, which is going to be there by the ICAI Delhi. And please, this is very important, because today only I have put it in reminder in my calendar, 25th May. Which today is 22nd, so maybe next Tuesday or so.
Yes,
it is there in the evening between 2 to 5 or 2 to 4, something like that. But please draw the attention of the members. They must attend this. The reason being, it covers the common errors in the tax audit report. Now, when it comes to the tax audit report, let me tell you, the CAG, the Comptroller and the Auditor General, or the department's tax audit. Now, even department has that auditors also. There is by the CAG. So even those are even CAG is also considering the vetting the audit reports, and they have come out with the many scathing remarks for the chartered accountant. But of course, they were looking from the compliance of the Income Tax Act only, and not the accounting standard. But now the tax accounting standard board, which is going to be set up, or which is in the process of being set up now, will be taking into account the compliance of the tax audit report from two perspectives: A, the accounting standards, and B, the income tax act. And sir, now we cannot afford to take things lightly. One thing is very common, and which is nagging and which is troubling all practicing members, and especially small and medium enterprises, is that the clients expect that we should do everything for them. We should do everything for them, or they think that their duty is over the moment they give the tally. Sir, I have given this tally, you do as per your testing. Whatever you feel like you do, whatever is okay, you do that. And even for correcting entry, when they give the tax audit, when they give the data for tax audit, they think that we have to audit even from, we have to do the audit even for the other aspects also, like correcting the journal entries, making errors, jo bhi error hai, whatever is that, we have to correct those errors and pass the rectifying entry. So if you tell their accountant, in all probability their accountant will mess up the matter rather than correcting or modifying or making some sensible changes. So we have the onus to do everything, right from preparing the cash flow statements or anything. Say, sir, you pass entries, journal entries. If the accountant has made mistake in the depreciation rate, sir, you please pass the entry. And they come at the last moment, sir. If the deadline is 30th September, they will come merrily on 20th of September and say, sir, my accountant was fallen sick, this, that, and they burden you a lot. Second problem which we normally SMEs face are the resources crunch in their own office, The trained personnel, they leave after the articleship is over, and the person whom we have groomed for so many years is not there to do your work. So you have to give this work to someone else, and that person will say, sir, I'll do in my own way. Now when he does in my own way, that means very scary thing. If you allow me to say something in Hindi, वो कहते मैं मेरे हिसाब से कर लूंगा. I'll do as per my own ways, and that is a very dangerous phrase. So what you should do, sir, you should make use of the certain of the technology. I heard that there are now some packages available, like for the preparation of the tax audit report and everything. You go to Winman and some other. I'm not marketing anyone, but there are some packages available which is everyone is using that. In the same manner, now few companies have come out with a package which will extract the data from Tally, and prepare the financial statements as per the directions given in the schedule division 1 schedule 3 to the Companies Act for the private limited companies. For the non-private limited companies, it will ask you the option whether you want the financial statements as per the division 1 schedule 3 to the Companies Act or the non-company entities, and it will give the balance sheet and notes everything as per the schedule 3 or not. And it will also transfer data to your accounting, to your package which you are using for the income tax preparation. So we should use the maximum use of the technology, correct? Because we cannot depend anymore now too much on the article clerk or the semi-qualified chartered accountant or the untrained personnel. See, there ultimately you are answerable, sir. Ultimately we are answerable, and we know that how much we have toiled, how much you have put efforts to pass the C examination, to get this degree, and even and after that, to get and maintain the client, to retain the clients, we have taken a lot of trouble. So see that a degree, hardened degree, is not jeopardized because of some clerks or someone's mistake, which is not in your control. Because ultimately we are responsible because we have signed, and we cannot use the argument or the excuse that no, he was a new article clerk or the semi-qualified and the data was received on just 2 days before the last day. No one is going to listen to you, sir. So let us make the most use of the technology, and there are very solutions available in the market. So as I told you, I sympathize with the small and medium enterprises practitioner brothers, and even the companies also, because they are suffering from the lack of resources. following standards are applicable to all one. So one thing is that cash flow should have been retained, but I don't know why they say that cash flow is not applicable to certain categories of entities. Cash flow, in my opinion, should have been retained, sir. Okay. Uh, okay. Now, these standards are not applicable to all three categories of MSME. Level 2, level 3, and level 4 entities. Cash flow statement is not applicable at all. So, entity having turnover less than 250 crore rupees is considered as level 2. So if it is not applicable to that, leave aside all other 4 categories. And then segment reporting, earning per share naturally is not going to be there. Consolidated statement and even the interim financial, and this is about reporting. And here I will say that rest 12 accounting standards are applicable with some exemptions for the level 2, level 3, and level 4 NSCs. AS 28 impairment is not applicable to level 4 entities at all. Impairment is totally exempt for level 4 entity. But anyway, sir, I'd like to mean that wherever the impairment standard is applicable, even to private or the other listed companies, how many of us have been doing the impairment test? Tell me honestly, how many of us are doing that? Because the moment we talk of impairment, the management takes a view as if we are talking in a derogatory manner for the management, as if we think that it is not good for the management. They always say, they no, let us not do impairment. But friends, here I'll tell you one very practical advice. See, what the standard says, that whenever there are indicators of impairment, whether external or internal, entity should conduct the impairment test. And only after the impairment test, if the carrying value of an asset, say 100, is more than the recoverable amount, which is say 90. If the carrying value is 100 and the recoverable amount is 90, only in that case you do the impairment, not otherwise. And we all know what is the recoverable amount is the higher of two limits, two amounts. A, the fair value less cost of disposal, and second is value in use. Entities should demonstrate that yes, at least they have carried out the impairment test. And then if it is not required, what do you mean not required? Then if the impairment is not required, don't do that. But at minimum, one must do the impairment test. I am talking this from the perspective of the corporate entities. Okay, nothing from the NC per se. Okay, and then we'll discuss in brief about the applicability of the other standards as to where they've been relaxed and all kind of thing. So I put in red marks. Secretary sir, Mr. Pandaraj sir, I'm going to share this PPT and the Excel sheet after this session is over. Okay, there is no big deal, sir. I've just reproduced the materials from the ICCI Publications. Okay, I don't call it intellectual property rights, sir. Okay, I'm just reproducing the material given by them.
Yes,
I'm just a presenter, sir. I'm just a presenter. Okay, so you can see, sir, this is again concerning the disclosure. Now, wherever there are exemptions, they say an enterprise is encouraged to disclose. So even this disclosure was not mandatory, but recommendatory. So the exemption has been given about this kind of disclosure, that carrying amount of the property, plant, equipment, everything. My dear listeners and the participants, I was requested by your chairman, Jalapati sir, and Mr. Pandaraj sir, sir, we would like to hear from you something about the property, plant, and equipment, and that too about the change in the depreciation method from either WDV to SLM or vice versa. And dear Secretary sir and dear the Chairman sir, I will definitely, as per your request, dwell upon something about the property, plant, equipment, because you have mentioned, sir, this is very, very important for our members to know this. So, sir, I accept your request and I'll dwell upon that.
Yes.
So this is about the exemption concerning disclosure. So, well, if you go to see, I would say no big deal. I would say no big deal, but still is an exemption. Same is the case with ACE 11, foreign exchange transaction. Disclosure is encouraged of an enterprise's foreign currency risk management policy, which is again exempted for the level 2, 3, and 4 entities. So level 3 and 4 entities not applicable. Level 2 is covered there. Now, again, exemption is concerning about the ACE 13, accounting for the investment, para 35F. Now, this is not applicable to level 4, but it is going to be applicable to level 2 and 3. When you see my Excel chart, you will see I have given that which standard is not applicable for the exemption to level 2, 3, and 4 companies. But this is just to give you an idea as to what they are in detail. And as regards ACE 15 is concerned, the same kind of exemption have been retained for the earlier, which was there, which is there, which was there, and which is there even for the non-company entities also. Okay, just non-corporate entities. Sorry, beg your pardon, non-corporate. Now, this is about the recognition of the measurement of the vesting of the short-term. Then recognition and measurement, this is concerning the about the standard concept for the defined benefit plans. We have defined benefit obligation and defined contribution plan. So majority of the exemption are concerning the defined benefit obligations and other long-term employee benefits. So this has been continued. Now, as far as the lease are concerned, you will see paragraph 25, paragraph 22, paragraph 37, and paragraph 46. 4 standards, 4 paras have been covered for the leases, but more or less, if you see, they are repeated. Why? Because lease standards is talking from 2 perspectives: A, the lessor; B, the lessee. And there are 2 types of leases. One is operating lease and second is the finance lease. So here it is the operating lease and the lessee. Here it is lessee and the finance lease. Here it is lessor and the finance lease. And now it is the lessor and the operating lease. Okay, sir. So all these are more or less same. This is concerning about the lease rentals more than 1 year, less than 1 year, more than 1 year, but less than 5 years time. So all basically these are disclosure exemptions. Okay, now AS22, as I have seen, as I mentioned earlier, is exempted from the compliance partially to level 4 entities. They don't need to recognize the deferred tax asset or deferred tax liability. And then they said that this is a very good, very well thought of thing. Though institute has done it so hurriedly and very fast, but they have been very careful about the tiniest aspect of the accounting standards applicability. Now, on the first occasion, when the non-company entity gets classified to level 4, so you were in level 3 as per the earlier classification, or maybe level 2 as per the earlier classification, but now you have been relegated to level 4 category. That means you were following the standard of the deferred tax assets and liabilities as per the earlier category, earlier classification. But now you're not supposed to follow because you've been pushed to level 4 category. So in that case, the accumulated deferred tax asset and liability appearing in the financial statements of the immediate preceding year will be adjusted against the opening revenue reserves, because you were following hopefully AS22, and now you're not required to follow the AS22 vis-a-vis deferred tax and asset, because to repeat, you are in category 4. So in that case, you will be recognized, technically speaking, this deferred tax asset or a liability. This is a very good example. AS28, impairment of the assets, exemption is applicable to level 2 and level 4. And then you may ask a question, sir, where is level 4 missing? Do you mean to say this exemption is not given to level 4? No, it's not like that, because AS28 impairment of asset is not at all applicable to level 4 non-company entities. Now, as far as level 2 and level 3 are concerned, we know that if an impairment test is conducted, what an entity has to see, whether the carrying value, that is the book value, is more or less than the recoverable amount. So say the carrying value is 100, recoverable amount is 90, you have to recognize the impairment loss of rupees 10. Now what is recoverable amount? It is the higher of two figures. One is the fair value less cost of disposal, and second is the value in use. For value in use, we have to estimate the projected cash flow for next 5 years time, discounting it to the present value, calculate the terminal value, and again bring it to the present value. And this all rigmarole, all detailed calculation for the estimated cash flow is to be done for arriving at something called value in use. So here some relaxation has been given to at level 2 and level 3 entities, that rather than doing all these detailed calculations, all that you're supposed to do is just make an probable estimates, and then you use this estimated value as the value in use. So they say just the reasonable estimate and not the detailed projected cash flow for 5 years, terminal value, which are reduced to present value using the appropriate. So don't do all this, just make a reasonable estimate of the value in use. And again, impairment, this exemption is for the disclosure. Again, 29 provisions, contingent liabilities and contingent. Again, this exemption is for the disclosure. That means you have to still account for the provisions and the contingent liabilities disclosure, and contingent assets are never recognized. Amalgamation, actually, this will not be applicable to level 4 entity at all. And why even level 2 3 also it may not be applicable, because unless there is no question of any amalgamation as such. Now these are not applicable at all to level 2 3 and 4 entities, unless a non-company entity, which is the partnership firm, is required to or elects to prepare and present the consolidated financial statement or the interim financial statements, or if a partnership firm enters into a JV. So these are optional, but I don't think no one will be interested in preparing the CFS or the interim financial report. And now we talk about the tax audit under section 44AB. The tax audits are the auditors. In tax audit, are we supposed to follow the accounting standards? The answer is yes, because it is considered to be an attest function from the perspective of the standards on auditing. Now, this is known as attestation service, means the services involving auditing or the verification of the financials in transactions, books, accounts, records, or the presentation, verification of the certification of the financial accounting related statement under this act of the Chartered Accountant Act. Now, but it does not include the management consultants engagement, representation client before the IT authorities. But in a nutshell, as far as today's webinar is concerned, we'll focus on the tax audit. Now, here is the preface to the statement of our accounting standards. Friends, I know that we have so much to read. And again, as your chairman, sir, has said, this is the generation of the changes. So we find very little time, but I believe so COVID-19 or has given some opportunity to all of us to read something, because had you gone to, had I come to Madras to deliberate, to dwell on this, I must have wasted at least 1 day time, correct, sir? And all members must have wasted time of 1 hour, 2 hours for commuting and going back to the home or something. But now, rather than you going to the temple, the God has come to your house. Rather than you going to the temple to worship the God ICI is come to your doorstep. So that has saved some time. So I would suggest, friends, you must read the preface to financial accounting standards. This statement will clarify so many things. And friends, the Compendium of Accounting Standard 2019 edition, sir, I strongly advocate you must read. I would say everybody must read this Compendium of Accounting Standard and read these standards once, Because when we had read the standards at the time of examination, and don't talk CAs like me who had cleared in 1983, where there were no standards or very few standards. During our regime, Mr. Panaraj, when did you pass your CA exam, sir? In which year?
86, sir.
86.
Yes.
So I think in your time also there were very less standards. Am I right, sir?
They are not mandatory.
Huh?
They were only recommendatory, no mandatory, not mandatory.
No mandatory standards, no mandatory standards, sir. But anyway, still, whatever little standards there, we studied only for the sake of examination perspective, and later on in the practice when we read. But I realized that when you in practice you read these standards, your understanding is magnified.
Yes.
You understand standards very correctly because you are connecting yourself with applicability of that particular standard. So so don't take for right that we have become CA and hence there is no requirement for us to read the standard. It is the job of only the article clerk to read the standards, not like that, sir. Take one chance and read the standard. You realize yourself that how effectively it helps you. Now, one gentleman came to me. This is about 5 years back, and he said that, sir, my client is an investor and he is invested in shares and stocks and all this, and he is treating the stocks, shares, everything as a stock in trade. So I advised my client, this is what he was telling me, that look, it is an inventory for you. I said yes, it is an inventory for him. So I advised him that inventory valuation is lower of cost, or the at one point of time it was market value, now it is a net realizable value. So I told him, I advised my client, okay, it is a lower of cost or the market value oblique net realizable value. But I said, let us do one thing. I was knowing it. I said, let's do one thing. You take this copy of standard, I'll take this copy of standard, and let's read AS2 valuation of inventories. And we came to paragraph number 2. This standard is not applicable to item number 2C, shares, debentures, and investment treated as a inventories, even if you're dealing in that. So the whole standard itself was not applicable, but still the gentleman was under the impression that it is an inventory, and I'm not blaming him. It could be his very bona fide impression that inventories, all whether lot, stock, and barrel, are to be measured at lower of LCM or the NRV. So please read, and it will enhance your understanding. Take my words. I realized one thing, sir, that when we take the opinion of certain big companies, I won't necessarily say the big 4 companies, because there are non-big 4 companies in India who are doing better and they are equally good as the big 4 companies. So whenever we go for some kind of opinion to them, they do one thing: they read the standards afresh. When we go to seek opinion on the income tax matter, I remember Mr. B.K. Khare, the chartered accountant, leading charge. He's not anymore now, unfortunately. So when I used to go to Mr. B.K. Khare, in good old days when I was a young chartered accountant and was seeking opinion of the stalwarts, and the we always believe in taking the second opinion. So Mr. B.K. Khare had one habit. He, despite being an authority, he'll always keep Income Tax Act and rules together. One copy he give to the client and one copy will say, Mr. Desai, let's read this standard. I said, sir, you don't need to read this standard afresh. So no, I have to read the standard. So this was his habit. So in the same manner, whether it is the GST, whether it is the Income Tax Act, whether it is the Companies Act, you must read the accounting standard or the act and the rules together. And this I have been taught when I was pursuing the course of the IBC. Then that one of the faculties also was advocating the same principle that Mr. Desai, or the students, when you read the insolvency IBC course or when you're pursuing this exam, take the act, regulations, and rules together, because in case of IBC, it is not the rules but there are regulations also. So friends, one advice: always read the particular standard or the act and rules, because you may be fall rightly or wrongly under the wrong impression of certain accounting principles or the provisions of the act. So please, one advice that you must read the standards very well. Now, again, this para was repeated in the paragraph 10.9 of this material, which is again Institute Desai. AS applied to this paragraph has been taken from on page number 62 of the guidance note on the tax audit. In respect of financial statements audited under section 44AB of the Income Tax Act, accordingly, members should examine the compliance with the mandatory accounting standard when conducting this audit. Now, the question arises, what if the client has not complied with these accounting standards? You cannot force him to, but of course, you can always advise and tell them the ramifications of that, that if you don't comply with the standard, I have to give the qualified report. And the moment I give the qualified report, it attracts the attention of the reader. Now that reader could be the tax accounting standard board established in ICAI or maybe the income tax department. So avoid this and please try to comply with the accounting standards. So we as a member should prevail on the client for the compliance of this. Mr. Panaraj, I'm going to discuss about your request about the accounting standard AS10. You were saying something, sir? You want to say something, sir?
Nothing, nothing, sir.
Nothing. Okay. LLP, which standard they should follow? LLP should follow the standards notified by the Accounting Standard Board of the ICAI, and to them the existing level 1, 2, and 3 will be applicable. They are not considered as a non-company entities because LLPs are the corporate entities. LLP are the corporate entities as per section 3 of the LLP Act, except one thing, except for the applicability as a tax as an auditor of the company, they are considered as a non-corporate and non-corporate entities, because LLP for the limited purpose of the auditor has to be considered as a non-corporate entity. Otherwise, LLP chartered accountant firms would not be able to audit the would not be the auditor of the listed company. So there is only limited exemption. So in a nutshell, LLPs are the corporate bodies as per section 3 of the LLP Act. And this is the tax review board established on the lines of the Financial Review Report Board. And that's the caveat. There's a caution that you must apply these standards very diligently. But before that, sir, I'll share one more thing, sir. Half an hour we keep for the members' questions answer. But I'm going to discuss what your chairman has told me and what your secretary Saab has requested me. And this is concerning the accounting standard called AS10 revised property plant equipment. So this AS10 revised property plant equipment is a replica of Ind AS16. They brought one very big important change, that three things: change in the method of depreciation, residual value, and useful life. Residual value, useful life, and method of depreciation. They are considered as an estimate. They are considered as an estimate and not an accounting principle or the policy. So a method of depreciation is now considered as per AS10 revised as an estimate and not an accounting policy anymore. So whether it is applicability to the AS10 to the corporate entities or the non-corporate entities, AS10 makes it very clear that method of depreciation is not considered as an accounting policy anymore. It is an estimate only. And this being an estimate only, a change in the method of depreciation, whether from WTV to SLM or SLM to WTV, is considered as a change in an estimate and hence applied prospectively. So my dear friends, if you want to change the accounting, the method of depreciation from SLM to WTV or vice versa, then don't apply it retrospectively. So many friends, my friends were saying, sir, because that after the concept of the useful life and the WTV and all this, they said WTV is very cumbersome to calculate and do the calculation of the WTV. So we prefer the SLM. But when we right now we are following the WDV method. But if we follow the SLM, if we change from WDV to SLM, it will be very cumbersome process because we have to apply it retrospectively. That's not the case anymore. With effect from April 2016 for the corporate entities and with effect from April 2017 for the non-company, non-corporate entities, change in the method of depreciation is not a change, is not considered as a change in an accounting policy, but it is a change in an estimate. That means you can apply it prospectively and not retrospectively. So, sir, Mr. Jalapati ji, I think you wanted me to dwell upon this particular aspect, and even including Panaraj ji has requested me. So I hope you are okay when I covered this. Am I right, sir? Both senior gentlemen? Hello.
Yes.
Namaskar.
Yes.
Namaskar, Chairman, sir.
Yes, sir. Fine, sir. Fine, sir. Covered, sir.
Yes, sir. Yes.
We can go for this question and answer session, sir.
Yes,
Selva?
please.
Yes, sir.
Hello.
We'll start sharing the screen,
Please,
sir.
flash.
We'll start. Sir, you can stop sharing your screen, sir.
Have I? Is it stopped, sir?
Yes.
Screen is
It's
stopped.
stopped
Okay.
now, sir. It's stopped now. No,
Yeah.
Okay, sir.
Yeah.
we'll start sharing your screen, sir.
Okay. What are the non-corporate entities? To my mind, a sole proprietor, a partnership, including
Selva,
LLP, AOP.
increase the font size.
Sir, Mr. Ravi has compiled it. I'll ask him to increase it, sir. Ravi, can you just increase the font size or else zoom in, please?
Anyway, I could read the first question. Mr. CA Purna Chandra Prasad. So very good question, sir. Very good question. And I like this kind of the basic questions. What are the non-corporate entities? Now, non-corporate entities are entities other than private limited company, public limited company, and even the LLPs. So LLP is considered as a corporate entity. If you look at the section 3 of the LLP Act, it says that they are corporate bodies. Same and except for section 226 for the audit matter. So my dear friend, the sole proprietor concern, partnership, not LLP, AOPs and the body of individual trust, municipal corporation are considered as a non-company entities. Now I will use the word non-company entities and not the non-corporate entities. Okay, the standards are they entirely different for the limited company, or when they no sir, there's no change in the standards. Standards, all 27 standards remain same. Absolutely no change in the standards. The only change is about the applicability of these standards to level 1, 2, 3, and 4 entities. They are known as the level 2, 3, and 4 are known as the MSME. So my dear friend, no change in the any accounting standards, only the changes in the applicability of the standard, and sometimes within the standard a limited exemption, maybe from measurement or maybe from the disclosure. Like AS22 is partially applicable to level 4 entity. As far as impairment is concerned, level 2 and level 3 entities are concerned, rather than using the value in use and all kind of detailed calculation of the projected cash flow, use the estimated value like this. Now, question 2, is the accounting standard of a non-corporate entity applicable to LLP also? If not, which are the standard applicable? Mr. Shanmugan M. Sorry, I have not been able to read the name very clearly, but my dear friend, again to repeat and reiterate, there is no change in the standards at all. Standards are remaining same. The classification has been changed for the applicability. And again, my dear friend, with the fact that for the non-company entities, level 1, 2, 3, 4 levels are there, but the level 3 which were there earlier, which is there today, are still intact for the corporate entities, meaning private limited company, public limited company, and the and the and the LLPs, and also the listed entities. Because even if a non-company entity is there, even if a non-company entity is there, but it is listed, then all standards will be applicable to that listed entity, even if it is a non-company entity. Friends, no new standards are there. Is LLP a company entity or not? I have given this answer. LLP is a corporate entity. Can we get this in? Yes, we will get. I'll give this Excel sheet with you for you, sir, because that's at minimum I do. I have to share this. I have to share it. It's meant for you only, dear friends. Okay, dear sir, non-company also include LLP, right, sir? Non-company does not include LLP. LLP is considered as a corporate entity. Hence, level 1, level 2, level 3, which is there even the year before, which is there for the private limited company, and these are still applicable to LLP only. Level 1, 2, 3 has not been changed. Only the changes for the applicability threshold limit criteria for the non-company entities. And see, the majority of questions is about the LLP, whether it's a corporate body or not. And I understand this confusion, sir. Nothing wrong. Don't feel shy of it. You must always ask the question. You have to be very inquisitive, because only then you learn a lot. As I told you, that LLP is definitely a corporate entity as per section 3 of the Limited Liability Partnership Act. But I'll tell you one more thing, that only, and I'll give that particular section also, sir, that for that particular section, so some things, and I don't remember too many things. So, okay. But for section 226 into bracket 3 into bracket A is not considered as a body corporate. And this is given in circular number 23rd May 2011. Circular number 23rd May 2011. It says, as per subsection 1 of section 3, LLP is a body corporate. However, for clause A, subsection 3 of section 226, it is not considered as a body corporate, because this 226 deals with the auditors for the company. Okay. For falling into any one of the criteria for the non-company entities, do we need to consider both the turnover? No, any one of them. Any one of them. Mr. Rajshekharji, it is any one of them. And once you get this document, once you get my PPTs, it is written very clearly. And sir, I'll also share with you the document issued by the ICAI on the 30th of March 21, which is a 2-page, 3-page document, and it's very lucid, very simple, easy to understand. Sir, is a proprietary organization covered under the NC? Yes, it is considered. But don't ask me that whether they will follow the standards or not, because it will be a very hard thing to convince them that there are these accounting standards and even they have to follow. Because they will only tell you one thing. I remember, because sir, you apply whatever standards you want to apply, but I'm not going to increase my fees for you. Okay. So that you have to be mentally prepared for that. If the turnover of the private limited company is less than 50 crores, still all accounting standard applicable to such companies can be classified under level 1. See, for the private limited company, now let us go to the that particular thing. Just a minute, please. You're not seeing the screen. Okay. Now the criteria for the limited company was, if the turnover is more than 50 crores, it was level 1. If it is less than 50 crore, which is your question, now, where is this, sir? Where is your screen? Where is yours? I can't see your screen now. Okay, I can see your screen now. So if the turnover of the private limited company is less than 50 crores, it will fall into category 2. If it is less than 50 crores but more than 40 lakhs, then it will fall into category 2. Still, all Ind AS are applicable to such companies. Can we classify them as level 1 entities? Mr. Srijit Kunnath, would you like to come alive? Would you like to say something? Because I didn't understand your question.
Maybe he might be posting it again. So I'll go with next questions. Let him post and
Okay.
we'll just compile it.
So whether this is this applicability is as per the ICAI, yes, this Mr. Rajshekar Shetty, this applicability is as per the Accounting Standard Board, because for the non-company entities there is no regulatory bodies to see the applicability of the accounting standards like the way it is there in the Companies Act. Whether the okay, how the turnover criteria to proprietors is limit is from for the how the turnover criteria applicable to proprietorship firms for the classification. It should be proprietary concerns. The same criteria, sir, for the non-company entities, whether it is a 250 crore, 50 crore, same is applicable to even proprietary concerns also, not proprietary firms. Why shouldn't the standard be made applicable for non-profit entities not carrying on the commercial business activity? There are so many trusts and societies. Mr. Venugopal, as if your request has been heard by the Accounting Standard Board, very soon there is going to be the applicability of the accounting standard to the trust also. And one more thing, sir, these standards, existing standards are undergoing a big change. They are going to be furthermore simplified and they will be in tune with the Ind AS. Like AS10 revise is a replica or the copy of Ind AS 16. So in future, not only the number, not only the standard, but even the numbers also will change to match with the Ind AS. But trust and for the trust, you said correctly, if the trust is carrying on the business activities, then only it is likely to, has to apply the accounting standard, not otherwise, but it may be applicable very soon. What is the difference between the application with the exemption and application with the disclosure exemption? Mr. Sriramji. Mr. Sriramji, I had given a detailed list of what are the exemptions applicable and exemption with disclosure exemption. If you've seen my presentation, I've made very clear that AS 15, AS 22, the exemption is concerning recognition and measurement both for certain paras. When it comes to AS 10, exemption is only vis-a-vis the disclosures. That means a disclosure about the idle plant and property and equipment which is idle but still in existence, you have to still disclose that. So there is an exemption from making this disclosure. That's what I mean to say, that with exemption and the applicable with disclosure extent. So it, when it says exemption only, it may be for some exemption from the recognition and measurement. For example, impairment for level 2 and level 3 enterprises. When it comes to the value in use, there is an exemption about the value in use methodology. But when it comes to the AS2 further, there is further exemption for the disclosure. That's what I mean to say, exemption with disclosure. In case of an LLP, a non-company entity, if it is formed after, sir, LLP is again a corporate entity. LLP is a corporate entity. So all this discussion about level 1, 2, 3, 4 will not be applicable to LLP. For the same question, do we have to prepare the ITR for the March 21 for, no, sir. So in that case, Mr. Gupta ji, this discussion will not applicable to LLPs because they are corporate entities. Please share the worksheet of the level. Yes, it is. I'm going to share this with you, sir, for sure. Sir, accounting for the taxes standards, current tax, in case of partnership firm, that the tax is not debited to profit and loss account, rather than it is distributed to the partner's capital account. Example, tax paid, advance tax paid during 2021 are debited to partner's capital account in the sharing ratio. The same also in case of prepared. How do we comply with AS? So, I do see your point as far as current tax is concerned. See, what you have done effectively is directly debited to the capital account. Had it been routed to the profit and loss account, it would have the impact of reducing the net profit and ultimately the net profit credited to the partner account or the partner's capital account, as the case may be. So rather than debiting straight to the capital account of the partners or the proprietor, you route it to the profit and loss account. That's simple as that. But when you do the computation of the income tax, for the purpose of income tax, you will say net profit as per profit and loss account, add item disallowed income tax. That care naturally you will take, and you will have to take care of that. But it doesn't make, as a matter of presentation, it doesn't make any difference vis-a-vis the recognition and measurement of the current tax liability. When Ind AS is notified, why is AS being adopted for NSC and not Ind AS? Also, what should be done? Transitional adjustment. Sir, transitional adjustment is only there for AS22. Transitional adjustment is there only for the AS22. That for the category 4 company, if you had by any chance accounted for the deferred tax asset as per the earlier classification, and now you are exempt, there is a transitional provision which I discussed very clearly, that it should be debited or credited to the retained earnings revenue account. Why Ind AS is notified? Why? I'm so sorry. When the Ind AS is notified, why A is being adopted for the NSC? Sir, Ind AS and the non-Ind AS standards, there are a lot of differences. Ind AS standards are very complicated as compared to the non-Ind AS standards. Forget about the Ind AS standard. If the applicability, if people are scared of or reluctant to apply the AS, I don't know what will happen to them when we talk of application of Ind AS to NCAs. They will say, rather we'll shut down our business, but please don't compel us to comply with these standards. See, As are relatively very simple as compared to Ind AS. And I don't think, looking at the level of the operations of the non-company entities, Ind AS is warranted in any manner, because in that case the cost of maintaining the accounts will be phenomenally high for the following of the Ind AS standards. Under the tax audit, there is ICDS compliance. Can you please highlight the compliance between these? So these are altogether different ballgame. The fact that you have to comply with ICDS, and there's a specific segment in your tax audit report about the compliance of the ICDS, does not necessarily mean that you're not supposed to apply the AS. Both are different and both have to be followed, unfortunately or fortunately. If the non-company client does not agree to disclose as per AS, are there any legal binding requirement? Then how do we address as a CA to qualify the tax audit report to draw the attention? Mr. Puttaraju, very pertinent question, very practical question, and you are going to encounter this argument from the clients. When there is no regulatory body for us to comply with accounting standards, who is the ICAI to compel us to follow these standards? They may argue like this. Register of Firms is not saying anything about the accounting standards, and there is no question of anybody to even guide about the proprietary concern or HO for the AOP or the BOI. And you're going to face this question from them, but then you have to explain them, sir. Yes, I agree with you that there is no statutory compliance. You're not required by any law, any act. But sir, I am a chartered accountant, and being a member of chartered accountant body, when I discharge my attest function, I have to see that whether accounting standards have been complied or not. If you don't want to comply, I won't force you. There won't be any FIR files against you. There won't be any legal case files against you. But as a member, in case there are non-compliance with the accounting standards, I'll have to qualify the report. Now, how many of us have the guts to do that is a different case, and how many of us will do is a different thing. But I think to protect your professional interest, You must say that, and then explain him, if I qualify this, if I qualify this, it may harm you than me. It may give more harm. It may cause more harm to you than me. And explain, sir. That's we have to just educate and cultivate, educate the client and convince them that it's not a rocket science. Just you to say what you are doing. You have been following this system of depreciating the assets. All that, sir, you have to do is that assets are depreciated using the useful life. You are recognizing the interest income, sir. All I want you to do is just make one simple line statement that interest is being recognized on the accrual basis. That's it. So by following these standards, you are not supposed to incur some additional cost. Only thing is that, and it will inculcate some kind of discipline in your accounting staff. So I think the onus is on us to explain our client and educate our client. I know it's a very difficult job. Section 145 of the Income Tax Act has mandated companies compliance. Please highlight. So 145 does not say that you have to follow the accounting standard per se. That say that it has to follow the IT standards, not the income tax accounting, not the accounting standard issued by the ASB. Are the trusts covered under the NC? Yes, they are. Do we have the publication of ICAI with report format? I am not too sure. I am not too sure, but I think very soon, I heard the vice chairman, Dr. Sanjeev Singhal, saying that for the level 4 enterprises, they are going to come out with some kind of guidance note wherein they will educate which will educate the compliance of the accounting standards for the level 4 enterprises. How to apply AS20 earning per share to partnership firm? Sir, it is not applicable to them. Level 1 enterprise, yes. Oh, no, sorry. I see your point. Sir, it is not applicable to that because this will be applicable only if level 1 enterprise is a listed entity. Only if it is a listed entity. What a very good question, Mr. TSR Siva Subramaniam, which is Siva Subramaniam. Very good question, very witty. You have read the standards very well. That if a level 1 enterprise not listed but turnover more than 250 crore rupees, then you can say that it being a partnership firm, earning per standard is not applicable. Very good remark, sir. So I give a talia for him. Okay, clap for him. While calculating the limits of the borrowing to find out what are the components which will sum up to find out the total borrowings. These are borrowing from the financial institutions at any point of time during the year. So friends, whenever we read these limits, be careful about whether this is applicable with reference to current year or preceding year. Like the small company definition, while the small company definition is the turnover criteria is with the reference to the immediate preceding year. Subsection 85 section 2. And again, my dear friend, there is again change in the criteria of the threshold limit of the small company. I think the paid up capital has been increased from 50 lakhs to 2 crores, and the turnover from 2 crores to 20 crore rupees have been increased, but that is applicable for financial year 21-22 and not financial year 21. Then in case for non-tax audit case, even in the non-applicability case, should we auditor follow the case? Sir, in case of a non-tax audit, you are not discharging any attestation function. If you're not discharging any attestation function, the onus on the members for the compliance is not there. Sir, why you wanted to use the word non-company entities instead of non-corporate entities, Mr. Veeramani? It's not me, sir. It's the accounting standard board. So they have used the word non-company rather than non-corporate. Had they used the word non-corporate, it would say that it would be creating confusion about the limited liabilities partnership also. Since the applicability of NSC, whether any specific format of FS, no specific format is recommended, but I would suggest always inculcate habit for the Schedule 3 requirement. Previous year figures are required to be given when you follow the accounting standards. Very much. AS 15 is applicable to the companies and the employees are more than 50 numbers. Now the number of employees goes below the 50 numbers. Whether is applicable? No, it is not applicable, because when the threshold limits come down, it is not applicable. Is it correct to write off the entire WDV of the assets in the year in which the company is in process of winding up and the report as impairment? So this question is about the company and not about the non-company entities, but still I'll address this question. The context is that the holding company globally acquired and the subsidiary in India and wants to write off the whole WDV of the tangible and intangible asset because it wants to have a balance sheet with the share capital and reserves. Okay, sir. So this you want to wind up the company. This question is concerning the striking of the company, I believe so. Now, just for the sake of compliance with the striking of the Companies Act requirement, you cannot write off the asset which is already there, which is functioning and which is ready to use, unless then there is one thing, that if you want to close the business, you reduce the useful life to 0. That is one way of writing it off. They reduce the useful life to 0 and then you can write it off. Shall we give the disclaimer straight that A's are not followed by the non-company entities, since our client company is saying that we are not statutory one? So disclaimer by you is not going to help you. The standard says, the institute guideline says that in case of a non-compliance, a member has to qualify. A member has to qualify and not disclaimer. Disclaimer arises when there is a scope limitation. What disclosure is required in case of changes in depreciation method? In case of change in depreciation method, you can simply say that the change in depreciation method is now considered as an estimate as against the principal, and hence the change in method of depreciation is applied prospectively and not retrospectively. And in a nutshell, just say that the impact in the current year on the profit and loss is XYZ. Had it been WDV, it would have been, depreciation would have been so much and the carrying value would have been so much. But now, since we are doing the SLM, the depreciation is XYZ and the carrying value is the new revised one. Can educational society be treated? Yes, it is. It is. If so, under which level of depends. Okay, in then education society, there as far as turnover is concerned, the gross amount of fees collected by it will be the criteria for the turnover. Should we maintain the notes account that's followed by the non-current along with the yes, notes to accounts is a must. So if as far as possible follow the notes followed by the private limited companies. Do we have a format? No format as such, but follow the formats given by the Companies Act. This will really help a lot. In fact, in our office, there's a tradition that we follow the vertical format and not the horizontal format anymore, because then even the articles will have the training for following the vertical model. Can LLP partnership firm be? Yes, LLP and partnership firm can be a subsidiary of a company. It could be associate of a company. It could be JV of a company also. So LLP and partnership firm can be either a subsidiary or associate or even JV also. The criteria is again that attest function. If you're deciding the attest function, you have to apply the accounting standard. When a particular age is applicable to NCE but not complied, sir, again this question is repeated, but quite understandably this is a common question and a common phenomena faced by all of us, that if the entity is not followed the standard, you will make you will qualify your report, but explain your standard. By disclosing this accounting policy, you are not doing something great, something different, something new. You can convince them, look, you are recognized in the sales only when the risk and reward are transferred, only when the delivery has been given. Correct? You recognize the cost when the delivery material has been received by you, and you are indirectly following this accounting standards. No denying. Mr. Panaraj, yes or no?
Yes, sir.
Everyone follows these accounting principles, right? But not in a so many sophisticated words or this thing. So all that you have to do is just write that thing in the form of accounting policies in a little formalized manner. That's it. You are already following the accounting standards in an implicit manner. Make it little formalized. Don't attract the attention of the people. Otherwise, I have to say that the entity has not followed the accounting standards. There's a non-compliance. Why do you want me to write this derogatory remark for you, which I don't like to, for my client, for my bread and butter, right? So you're not doing a great job. You're not doing an additional extra work by stating the fact that yes, you have been following this accounting policy. That's it. LLP is now, we've clarified very clearly, sir. Sir, good evening. While checking the category of NSC to financial year 2021, whether we have to consider the turnover, the bank borrowing for the financial year, sir, it has been very clearly written that the turnover is as per the preceding year and borrowing is any time during the current financial year. So how many more questions are there? It looks like there are 100 questions. Okay.
Well, the 45th is the last one, so the last 4 questions.
Okay. Can you please clarify the ICDS standards and accounting standards? Which standard to be followed for the tax? So you have to follow the both standards. You have to follow the both standards. Whether the NPOs, residential owner apartment are need to. Oh no. You're talking about the housing cooperative societies now, because they are governed by their cooperative society rules. They are governed by their own statutes. So there, if you do a test function, you have to follow the accounting standard. But if it is not covered, then you have to follow them. Whether the turnover is including tax and excluding GST, the turnover is always excluding tax amount. And let me draw one thing. You're not asked this in the question, but allow me a minute, please. Allow me a minute, and I will tell you something else. So 1 minute, please. You're not asked this question, but let me tell you. The question is concerning the question raised by this gentleman. The semi-last question also was just a minute, please. Was about that whether it's excluding or including the GST. The answer is very simple. It should be excluding GST, but it is excluding other income also. It is excluding the other income also. So I'm going to share this document issued by the ICAI and my PPTs, which makes following things clear. Whether it is both the conditions or only one of them. Whether turnover current year or preceding year. Whether current year or preceding year as per audited balance sheet or no, it is also there. And whether borrowings is as per the preceding year or the current year. Borrowing is for the current year, turnover is for the preceding year, not necessarily the audited. Good evening, sir. AS 15 is applicable to companies. Again, I think this question was repeated. Once it falls below the threshold limit of 50, it is not going to be applicable anymore.
Those are the questions. Complete.
Oh my God, it's exactly 8 o'clock, 6 minutes.
Yes, sir.
What a
Yes,
timing.
Yeah. Thank you very much, sir. Chairman, shall we conclude?
Yes, sir. Yes, sir.
Sir, Yagnesh Desai, sir, very good evening for this learning process, and they have taken so many questions. That's why Chairman intended that half an hour is required for the questions.
Yes,
So,
you had mentioned it correctly, sir. I mean,
yes.
you knew the pulses of your members, and more so, this is the first of its kind for the NC. And sir, let us admit it very clearly that the compliance of the standards for the non-NCs is very poor, not because we don't know. We know, but our clients don't agree. But now
Yes.
all that we can say is that my client, see, you're doing it, sir. You're already following the accounting standard. All that you have to put is just in a little format. That's it.
That's it. Yes, yes. That's the simplest way of explaining the things. And
Explaining things.
yeah, most of the members are now aware that what are the standards that are applicable to non-company entities, as well as the mandatory requirement and the non-compliance, the effect of non-compliance. This is made very, very clear today, for which we thank you on behalf of the SIRC for your time and your presentations.
My pleasure, sir. You invited me is a big thing. I was not keeping well, but I didn't say no. Let me now tell you and admit you that I was not keeping well. You could see that I was sneezing incessantly, but still I didn't want to say no to it. Okay, sir. Once it is committed, it has to be complied with.
It's great of you being so senior member and also being relatively ill. You have stuck to your commitment and you have done your job for the alma mater, and you are the real assets of the institute. For your information, all along it is more than 440, around 450 throughout the 2 hours.
Sir, very good, sir.
As you rightly said,
so I'll share 3 things. I'll share 3 things with you, sir. One, the PPT prepared by me. Second, the Excel sheet, and the third, the clarification statement issued by the ICAI.
Please
and request your members, all my members, friends, please read the Compendium of Accounting Standard. Read once, sir. Once. It may take 3 to 4 days to read the complete, but then you get a feel of it.
Yes. Thank you. Thank you very much for your guidance, sir. You have every right to give advice because of your age and experience. Thank you very much on behalf of the SIRC.
My pleasure, sir.
Thank you, sir.
God bless you.
Thank you
All
so
of you
much.
take care.
Thank you,
Be safe.
Good night, sir. Good night. Be safe.
Good night. Good night.
I also thank all the delegates for the big numbers that you are.
Yes, all the delegates. Yes, a special thank to them. So, anyone wants to say something, good remark, bad remark? I'd like to hear some remarks from them. Anything. I mean, I'm open to bad remarks also, sir.
Get the feedback, sir. We try to communicate.
We'll be sharing the feedback to you, sir. We have sent the link.
Feedback,
Yeah,
sir, will
okay.
be-
Yeah, if you give me the feedback, nothing like that, sir. Thank you.
Definitely.
Okay, sir. Good night. Take care, sir. Take care.
All the delegates,
Thank you, sir. Good night.
Thank you, Shalva.
Good night, good night, sir.
Thank you all for the days.
And
And
I
I
must say, I must say the lady called Monica, and there was another lady who had called me up.
Uma
So
Suresh.
thankful to them. They, huh?
Uma Suresh.
Uma's race.
Yeah. And one more lady was there. One was Monica. Second is
Shivani.
Uma's race.
Uma Suresi. She's the first one to contact me. So Uma Suresi, thank you very much about that. And another lady also, Monica, and all your
Thank you.
staff members, and Mr. Salva over there who sent me the.
Selva. He's the technical
Selva.
person, sir. He's the technical.
So good job, Mr. Salva. Good job.
Thank you, sir.
Thank you, sir.
Now
Thank you
their
so much.
support staff we can't prosper, we can't conduct
night.
all this. Good
Yes.
night.
Good night, sir. Good night.
Good night.
Right, sir.
Good night. Take care, sir.